freeze your thumb, close the price app, and stop doom-checking your silver chart like the next refresh will undo what just happened. Because the last few hours in silver weren't a normal dip, and they weren't healthy consolidation. They were a rapid, engineered reversal, clean, mechanical, and timed like a trapdoor. And if you're about to tell yourself, relax, this is just buyers and sellers doing their thing, let me challenge that. Do markets usually erase a week of gains in an afternoon without a matching fundamental headline? Today is Tuesday, January 27th, 2026. Early this morning, silver tagged $117.70 an ounce, an all-time high, a new historical print, the number everyone said would take ages to reach. Momentum traders were celebrating. Longtime believers felt vindicated. Even skeptics were forced to pay attention. Then the floor opened. By early afternoon, silver was down near 103.89, roughly a 6.5% intraday punch. About $14 an ounce vanished so fast that anyone leveraged felt it like whiplash. If you bought the breakout with borrowed firepower, this wasn't uncomfortable. It was a wipeout. Here's the crucial point. This didn't occur because silver suddenly lost real-world usefulness. It didn't happen because factories stopped needing metal at lunch. It didn't happen because the planet discovered a new substitute overnight. This happened because the paper plumbing got yanked hard. So today we're going to map the mechanism, the motive, and the consequence. And then we'll talk about what this means if you hold physical silver or if you're thinking about getting involved. If you value these kinds of breakdowns, the stuff glossed over on TV, stick with me. The story is not just the crash. The story is what had to happen behind the curtain for a crash like that to occur. Let's begin with the lever that can halt any futures frenzy instantly. It's not magic. It's not a secret memo. It's a rule change with a bland name and brutal effects, a margin increase. In plain language, futures markets run on collateral. You don't pay for the whole contract. You post a fraction to control it. One silver futures contract is 5,000 ounces. At triple-digit silver, that has a massive notional value, but traders might only need tens of thousands in margin to hold it. That's leverage, and leverage makes markets move fast. But here's the catch. The exchange can rewrite the collateral requirement. When they raise it, everyone holding positions must add cash immediately or get forced out. That is the pressure valve. That is how rallies get smothered without changing a single fundamental. On January 7th, 2026, CME Group announced a huge jump in silver futures margins, about a 47% hike. Pause and do the math. If a fund holds 100 contracts, that's more than $1 million in additional collateral demanded on the spot. If a smaller trader holds 10 contracts, it's a sudden 5-figure call. How many traders keep that kind of idle cash doing nothing? Not many. So what happens? They sell. Not because they changed their mind, not because demand vanished, because they have no choice. The exchange simply made the seatbelt cost more than the seat. And when forced selling hits an already crowded trade, price doesn't glide lower. It drops through levels like a trapdoor. Now ask yourself, was the timing random? Or was it chosen? Silver had just cleared $110. Momentum was accelerating. Shorts were under pressure. Meanwhile, the physical side was flashing warning lights. Lease rates, what it costs to borrow silver, spiked toward 8%. Typical lease rates live under 1%. When borrowing costs explode like that, it often signals tightness in real metal, not just speculative excitement. So picture the situation from the viewpoint of large, short players. If silver keeps sprinting, 120, 130, 150, the paper structure strains. Losses compound. Liquidity gets tested. If enough longs demand delivery while inventories shrink, the whole system risks a credibility crisis. Then, right as the move got dangerous, the rule changed. Margins up, weak hands out. Liquidations cascade, rally decapitated. And if this feels familiar, it should. This is not the first time this playbook appears when silver gets too loud. In 1980, as silver surged toward $50, rules were tightened and new long positions were restricted. The air came out fast. In 2011, as silver threatened the old peak near $49, margins were raised repeatedly, 5 times in about 8 days, followed by a steep fall into the mid-20s. Pattern recognition matters. Now, does that prove every tick is rigged? Markets are complex, but it does show something undeniable. The rule makers have a tool that can instantly force mass selling, and that tool tends to appear when price action becomes existential for heavily short participants. So, who are the repeat characters? Let's name one, because this is not internet folklore. JP Morgan paid a $920 million penalty in 2020 tied to precious metals manipulation, spoofing, and other tactics over multiple years. That's a legal outcome, not a vibe. And JP Morgan remains a major actor in these markets, with deep involvement in both paper flow and physical holdings. So when a record high is followed by a sudden margin shock, and the same mega players are embedded in the ecosystem, it's reasonable to ask, is this about protecting the public from volatility or about protecting key shorts from disaster? Either way, the next part is the real headline. Because while the screen price was falling in New York, the physical world was telling a different story. And that gap is where the future lives. Here's a number to sit with. After the smash, futures pricing showed roughly $111 in places. Yet reports circulated of physical silver clearing near $130 per ounce in certain markets. Premiums surged in multiple regions. Dealers in the US saw spreads widen on coins and bars. The point isn't the exact quote in every city. The point is the direction. Paper down. Physical, sticky, or higher. That separation has a name in my mind. A split reality. When the quote on a screen stops matching what it costs to obtain real metal, the reference price begins losing authority. And once authority erodes, it's hard to restore. Why does this happen? Because paper can be created in unlimited size, contracts, claims, and promises. Physical supply cannot. Physical metal must be mined, refined, fabricated, shipped, and delivered. That chain has limits. Look at inventories. COMEX registered stocks, the category most directly available for delivery, have fallen dramatically since 2020, with declines discussed in the range of 70% over that period. London has also seen notable draws. And in early to mid-January 2026, roughly 33.45 million ounces were reportedly pulled for delivery from COMEX, around a quarter of registered inventory in about a week. When outflows accelerate like that, it signals a demand for certainty. People stop trusting later. They want now. And then you add geopolitics. On January 1st, 2026, China implemented strong export controls, treating silver as a strategic dual-use material. Export now requires approvals, and only a limited set of companies were licensed for the next 2 years, reportedly 44 firms. Why does this matter? China is a processing powerhouse. It refines and handles a massive share of global flow. So if China narrows export routes, the rest of the world doesn't just lose supply. It loses the middle layer that turns ore into usable industrial metal. The immediate effect showed up in premiums. In Shanghai, physical premiums over London, spot reportedly hit about $8 per ounce, described as record-wide. Buyers respond to restrictions the way people respond to storms. They stock up before shelves go empty. Now zoom out. This isn't only about stacking bars. Silver is inside modern infrastructure: solar panels, EV systems, semiconductors, advanced electronics, and military hardware. If a major power can influence the flow, it can influence the speed of entire supply chains. Is it any surprise governments increasingly treat metals as leverage? So if physical conditions look tight, why didn't price simply float up and stay up? Because, for now, paper remains the loudest microphone. Futures markets still dominate the headline quote, but that dominance is weakening. Every time the paper side is stabilized through rule shocks, more participants ask whether the quote is a discovery mechanism or a management mechanism. And when enough people stop believing the paper quote, they change behavior. They stop renting exposure. They start demanding metal. That's when the system reaches a breaking point, not because of a tweet, but because of delivery constraints. Now, let's talk about who got hurt, because margin shocks don't punish the market. They punish specific people. When collateral requirements jump and price drops fast, losses concentrate in leveraged hands. A dramatic example surfaced in India. In Rajkot, a known hub for silver trade, reports said 44 silver trading firms declared insolvency after the margin change and sudden price decline. Combined liabilities were cited around $425 million. That's not a bad day. That's a crater. And here is the cruel twist. Physical pricing in India didn't mirror the paper drop. On India's multi-commodity exchange, silver hit a lifetime high around 15,692 rupees per kilogram on January 7th, roughly 113 per ounce depending on conversion. So in some places, real demand stayed hot while paper positions were forced to unwind. That contrast reveals the core lesson. Some traders had the right macro idea, but the wrong vehicle. Leveraged paper exposure can be destroyed by rule changes. Physical ownership doesn't receive a margin call. This story isn't limited to small players either. Large commercial participants have carried major short exposure for years. CFTC commitment of traders data around early December 2025 was discussed with commercial banks, net short roughly 212 million ounces. At $100 silver, that's a notional short of about $21 billion, and every dollar higher costs about $212 million on that exposure on paper. When silver ran up through 2025, those losses would have expanded rapidly. So if you were one of those shorts, what would you want most? Relief, a break in momentum, forced selling, a reset. When margins rise and price breaks, who benefits? The players needing to buy back or defend shorts. That doesn't require a shadow meeting in a dark room. It only requires incentives, structure, and the legal ability to alter requirements. But here's what those mechanisms can't manufacture. Metal. They can nudge paper quotes. They can shove charts. They can flush leverage. But they can't create a fresh mine supply overnight. They can't refine supply with a keyboard. And they can't stop industrial consumption that burns through ounces every month. So if you're holding physical, where does that leave you? It leaves you with something outside the margin system. You're not forced to post collateral. You're not auto-liquidated. You're holding an asset that exists in reality, not as a settlement entry. Paper can scream, metal stays silent. Now, where does this go next? What is the end game after a move like today? Because knowing why matters, but knowing what now matters more. There are 3 broad paths from here. Path 1, the system reprices upward. In this outcome, paper markets eventually allow the move and the quote climbs to match scarcity. Silver could push $150, $200, or more as shorts cover and physical premiums normalize. That's the clean bullish resolution. But it requires the gatekeepers to stop fighting. Today's actions suggest they're still fighting. Path 2, the separation becomes the new normal. The futures quote continues to exist, but physical trades at a consistent premium that reflects real constraints. 2 pricing worlds, screen silver and street silver. If trust breaks, it rarely snaps back quickly. And when Asia pays far above futures, it signals the reference quote is no longer the final word. Path 3, delivery stress triggers an official failure. The nightmare scenario for paper credibility is force majeure, where physical delivery can be met and contracts get cash settled. If the marketplace that sets the price cannot deliver the commodity, its quote becomes a suggestion, not a truth. In that outcome, paper price could collapse as confidence evaporates, while physical price leaps because supply is finite and urgent. We've seen near misses in other metals. In March 2020, during the COVID logistics chaos, physical availability issues sent premiums soaring and strained the system. Silver could face a harsher version because it's smaller, more volatile, and more industrially consumed. Now connect that to today. A margin shock and a rapid smackdown aren't proof everything is fine. They're evidence the system is sensitive. When a structure has to slam on the brakes this hard, it suggests the engine was approaching a red line. Ask yourself, if the paper quote were fully trusted and fully backed, why would confidence require emergency-style rule pressure right at a historic high? What does that say about underlying fragility? And here's the paradox. Each time the paper side is forced lower, it creates a window for physical buying. Each smash widens the gap between what the screen says and what reality demands. And each widening gap educates more participants. The paper managers may win individual skirmishes, but they lose credibility with every intervention. The bigger the shove, the louder the shortage whispers. So what should you do with this? Let's make it practical. First, if you own physical silver, don't let a paper-driven downdraft scare you into dumping. A futures margin rule doesn't change the number of ounces the world can mine this year. It doesn't change the role of silver in electronics, energy, and defense. Today's move was structure, not substance. Second, if you're considering buying, understand the difference between exposure types. Pullbacks caused by liquidation can be opportunity, but the instrument matters. ETFs, unallocated accounts, and futures all carry counterparty and rule risks. Physical ownership is a different category. Only you can decide what fits your risk tolerance, but you must know what game you're in before you play it. Third, be honest about timing. The resolution could come fast, or it could grind for years. Nobody can promise the date. What we can observe is the direction of pressure. Industrial draw, tight inventories, geopolitical constraints, and recurring interventions. When a system fights physics long enough, physics wins, eventually. Fourth, widen your inputs. Don't rely on one headline. Watch COMEX inventory data, lease rates, premiums, and the COT reports. These are imperfect signals, but they're real signals. And when you look at them consistently, the fear factor drops because you stop reacting to candles and start reading structure. And finally, if this breakdown helped you, support the work. Tap like, subscribe, and tell YouTube you want more from Business Limits. Comment your take. Was today a normal shakeout or a structural intervention? Your engagement helps these conversations reach people who don't get them from mainstream coverage. Because most outlets will reduce this to a shrug, metals were volatile. They'll ignore how margin changes can force selling. They'll skip the physical premiums. They'll avoid the uncomfortable question of who benefits when the brakes get slammed. What we saw today looks like a defense of the paper system, an attempt to keep a runaway move from becoming a confidence crisis. It worked in the short run. But the underlying issue remains. Physical supply isn't infinite, and demand doesn't pause just because a chart got punched. Hold your plan. Study the mechanics, and don't confuse a managed quote with real-world value. Thanks for watching, and I'll see you in the next one.